We're drawing heavily on insights from Rick Rule. He's
Oh,
obviously a big name, lots of experience in this area. We've looked at a bunch of his recent interviews, talks.
Exactly. And the goal here is really to boil it all down for you. What are the key takeaways on AI's role, the market right now, especially from Rule's perspective? What do you need to know? Okay, let's get into it.
So first off, Rick Rule on AI. It's interesting. He doesn't just see it as like a task automator. He thinks it's genuinely about creating value.
Right. He brings up his own history, doesn't he, with Bloomberg?
He does. He remembers when Bloomberg first came out and could do comparative analysis automatically.
Yeah.
Stuff that used to take his team weeks suddenly crunched down into hours. A massive shift.
He sees AI tools like Grok maybe doing something similar, but even faster.
Yeah, he speculates that in, say, the next couple of years, you could potentially do that kind of deep peer analysis in maybe 15, 20 minutes, which is just incredible.
It really is, and this leads him to a key distinction he makes between people who assemble information and those who think using it. Can you unpack that a bit?
Sure. So the assemblers, their main job is gathering, organizing data. For them, AI is a huge disruptor, kind of like Bloomberg was back then. It automates a lot of that grunt work.
Okay, so that group might feel the pressure.
Definitely. But for the thinkers, the people, maybe like you listening, who take information and use it to solve complex problems, generate unique insights, create value, AI is more like a powerful new tool. It makes their work potentially much more efficient.
More efficient and potentially more lucrative for those who can harness it.
That seems to be his point. Like with other powerful tech, AI could widen the gap, between the value creators, the thinkers, and maybe those who are more consuming information. The rewards could get even more concentrated at the top.
So for you navigating this, what's the skill to focus on then in this AI world?
Well, this is crucial. Rule really hammers this home. It's about asking the right questions, the kind of insightful questions that AI can help you answer, leading to genuinely valuable conclusions. And then, just as important, figuring out how to deliver that value so others recognize it, pay for it.
Makes sense, but let's narrow down to junior resources. It's a tricky sector, lots of nuance. Can AI really grasp all that right now?
That's a great point, and Rule says basically not yet, especially when it comes to the human element. Assessing the management team's psychology, their actual competence on the ground.
Like his example of Brent Cook.
Exactly. Someone like Brent Cook with his deep, almost intuitive grasp of geology in certain tricky areas. AI just crunching data probably can't replicate that kind of feel.
That qualitative edge.
Right. So for you, especially in early stage exploration where people matter so much, that assessment of individuals, their track record, their integrity, that's still a key human advantage. AI isn't there yet. Developing your own judgment on people remains critical.
So that human element, that experience, it's hard to code. Does Rule see areas where his own expertise remains, proprietary, where AI won't easily catch up?
Yeah, he does. He mentions a few things. Deep macrogeology, understanding the big picture of ore deposits. Also, the nitty-gritty of fiscal terms in different countries, taxes, royalties, how they impact project economics. That stuff varies wildly.
And cost of capital, right?
And his specific way of calculating the cost of capital for projects, using his own variables, he feels his knowledge in these areas gives him an edge, probably for his lifetime.
Okay, so the high-level strategy, the deep domain knowledge, but where will AI really help investors and resources?
Oh, definitely in cutting through the data drudgery, sifting through mountains of reports, numbers, news. AI can do that incredibly fast. It frees up so much time.
Which lets the human analyst focus on those bigger questions, the strategic stuff, the people assessment.
Exactly. But here's the catch.
There's always a catch.
He estimates that maybe only the top 10% of companies are currently set up to really use AI effectively to create value. Most, he thinks, haven't figured out how to apply it meaningfully yet.
That's quite a low number, so a lot of hype, maybe, but practical application is lagging for many.
Seems to be his view. And it ties back to the human element again, doesn't it?
How so?
Human bias. Rule points out we all tend to look for information that confirms what we already believe. So using powerful tools like AI requires real intellectual discipline, psychological preparedness, so you don't just end up amplifying your own biases with fancier tech.
That's a really important point. Okay, let's shift gears a bit. Junior resource speculation itself. Rule is pretty blunt about the mistakes investors make here. What does he see as the main culprits?
Well, he used to say time and greed were the big two. But he's added a third, maybe even fourth, if you count laziness within greed. He basically says too many people want to believe a story is true because the potential payoff is huge instead of doing the actual hard work, the due diligence. wishful thinking.
And that's dangerous in a sector where the failure rate is, well, pretty high.
Astronomical, really. He throws out a number like 90% of juniors ending up essentially worthless. Yet investors make what he calls a 100% valuation mistake. They assign real value to these long shots without really digging in.
Chasing those penny dreadfuls hoping for a 10-bagger.
Exactly. Without checking the management's track record, the project's actual potential, the finances, it's often just, as he puts it, got a hunch, bet a bunch, which is flawed.
And there's a mismatch in time frames, too.
Huge mismatch.
Yeah.
Investors often think tactically, like 3 months ahead. But resource projects, turning a discovery into a mine, that takes years. Often 5 years, maybe more. You need strategic patience.
It clashes with our instant gratification world. He also brings up Buffett, doesn't he? The whole be fearful when others are greedy.
Yep, the classic Buffett dictum. Be brave when others are scared. Be scared when others are euphoric. Rule says most retail investors get this totally backward. They pile in during the hype, then panic sell during downturns, buying high, selling low.
Does he give examples? Maybe even times he struggled with it himself.
Yeah, he's pretty open about it. He mentions hesitating to really load up on Exxon during the COVID crash when oil briefly went negative and sentiment was just awful. Even he felt the fear.
Makes him human.
It does. But he uses it to reinforce his own rule. Sometimes stuff is cheap enough.
Yeah.
You have to recognize that extreme fear creates opportunity, and you need the conviction to act.
And that cheap enough idea applies differently depending on the company size.
Absolutely. For a giant like Exxon, cheap enough means looking at their long-term prospects, their capital discipline. For Tiny Junior, cheap enough might mean it's trading way below its cash balance. But that requires intense scrutiny. What are they doing with that cash? Is management trustworthy?
Yeah.
Much higher risk, different kind of analysis.
Okay, let's pivot to gold. Rule seems pretty clear on where we are with gold right now.
Yeah, he's firmly in the camp that we are in a gold bull market. And he actually thinks it started way back, maybe around the year 2000.
2000, wow, that's a long run already.
It is. But he frames gold primarily as insurance. Insurance against fiat currency losing value over time, which it consistently does, and insurance against geopolitical turmoil, which we certainly have plenty of.
And the price performance since 2000 supports that view.
Definitely. He points out gold is up something like 12-fold since then. But, and this is key, he also notes that gold and precious metals still make up a historically small percentage of total U.S. investment assets, way below the long-term average.
Meaning there's potentially a lot more room for investors to allocate money to gold.
That's the implication. If allocations just went back towards the historical mean, given the relatively tight supply of gold, that could mean significantly more demand and potentially higher prices.
So for you looking to invest in this, how does a typical gold bull market play out according to Rule? What moves first, what moves later?
He describes a common pattern. First, the gold price itself starts moving up. Then the big established gold producers start to outperform. After them, you see the mid-tier producers and developers catch a bid. And finally, often later in the cycle, the junior explorers really take off.
And those juniors, they move later, but potentially faster.
Exactly. Later, but often much further and faster in percentage terms. Huge leverage, but also huge risk.
So based on that typical sequence, where does Rule think we are now?
His read is that leadership is currently shifting away from just holding physical bullion towards owning the high-quality gold stocks, which suggests we're moving into that second phase, but maybe still relatively early in the overall cycle for the equities.
And within the equities, he often highlights royalty and streaming companies, right?
Yes, absolutely. Companies like Empress Royalty, or the classic example, Franco-Nevada. He loves the royalty model in a bull market because their revenue is tied to the gold price, but their costs aren't directly tied to mining operations. That grosses your net idea gives them great leverage to rising prices.
What were the big lessons from Franco-Nevada's success story?
Two main things, he says. One, just how powerful and resilient that royalty business model is. Two, an observation that big, world-class deposits tend to get bigger and better over time as companies keep exploring around them.
But now there are quite a few royalty companies out there. How do you pick the good ones?
Good question. Rule stresses you need to find companies with a real edge. What's their advantage in sourcing good deals? Do they have genuine technical expertise to evaluate projects properly, like he believes Empress has through its connection with Endeavor Financial? It's about finding that definable business advantage.
Okay, let's shift again. The brokerage industry. Rule thinks it needs a shakeup.
He does. He applies Pareto's law, the 80-20 rule. He figures maybe 20% of brokers generate most of the value, another 20% might cause most of the headaches, and the real profits are even more concentrated.
And the core problem is misaligned incentives.
That's his main critique. The industry is often set up to reward gathering assets, getting more clients, more money under management, rather than necessarily delivering the best performance for the client.
He makes a comparison to politics that customers, like voters, sometimes want to be lied to.
Yeah, a bit cynical, but his point is people often chase unrealistic promises. And the rewards in brokerage often go to the best salespeople, the ones best at bringing in assets, not always the best investors or analysts. He quotes Buffett on why Buffett doesn't run money for others with high fees, because I can't get 3 and 30, implying the sales aspect isn't his strength or focus.
So being a good salesman isn't the same as being a good long-term investor.
Not at all. Sales is often short-term focused. Investing, true value creation, is long-term. Different skills, different mindsets.
Looking ahead, macro picture. Rule expects more volatility.
Yeah, he anticipates the next couple of years could be quite choppy in the markets.
So how should you prepare for that?
His main advice is hold more cash than usual. It does two things. One, gives you firepower to buy when opportunities pop up during panics. Two, it's psychological ballast. It helps you stay calm and rational when markets are going crazy.
Dry powder and a cool head. What about strategy? Just stick to your guns or adapt?
Be nimble, he says. Focus on logic, not chasing fads. Market leadership can change quickly. Apply that to gold, for example. A short-term trader might play it differently than a long-term investor holding for the cycle. But he does note gold stocks look relatively cheap compared to the metal price right now.
And what about oil? What's the strategy there?
His approach is generally to look for buying opportunities when oil sells off hard, especially if it goes below what he sees as the global all-in cost of production, maybe around $60 a barrel. Then reassess when prices are much higher.
Because prices below $60 aren't sustainable long-term.
Right. Economics just don't work for much of the industry below that level for a sustained period. If prices stay low, he expects more M&A, companies consolidating.
But he has some specific concerns about Canada's oil patch.
He does. Despite strong fundamentals for many Canadian companies, he worries about the political headwinds, policy uncertainty, stuff like that, making it a tougher place to invest right now compared to other jurisdictions, perhaps.
Okay, let's dive into some specific sectors he's talked about. Uranium, still positive.
Generally positive, yeah. He sees encouraging signs in the U.S., partly due to potential policy shifts. He was involved in discussions previously about maybe reversing orders that hurt the domestic industry.
But it needs more than just federal support, right?
Absolutely.
Yeah.
He stresses you need supportive state and local governments, too. Places like Texas, Wyoming, Nevada, Alaska, alignment is key. On the stocks, again, it's that sometimes stuff is cheap enough idea, recalling Paladin's past swings. Long-term, he's bullish, sees improving performance from Cameco, Westinghouse, even potential new demand from data centers needing power. But expect volatility.
Okay, what about coal? Thermal versus met coal.
He notes thermal coal is, very unpopular in the West, vilified even. But it's essential for power in many developing nations. That hatred can make the assets cheap. Met coal for steel is less hated, but he expects maybe some equalization over time as the need for steel is also undeniable.
And nickel. What's driving that market?
Supply, mostly. Increased laterite nickel production, especially for the Philippines and Indonesia, has weighed on prices. Lower energy costs help make that production viable.
So supply is up, prices are down, demand outlook.
Long-term demand should grow, especially with EVs.
Yeah.
Lower prices might even spur new uses. But he thinks that'll take time to really kick in, maybe beyond 2025, 2026. So near-term pressure, longer-term potential.
Got it. And the Origin Royalties triple flag deal, he commented on that.
Yes, positively. He mentioned he's taking his compensation in triple flag shares, which is a vote of confidence. He thinks there might be a temporary sell-off in both triple flag and the remaining Origin stub after the deal closes, potentially creating a buying opportunity.
He still likes the underlying Origin business.
Yeah, acknowledges their strong prospect generation side and the work Anglo-American did on the assets sold. He actually recommended listening to Brian Dalton, CEO of Altius, who's a major Origin shareholder, for more insight.
Interesting. He also touched on Canadian politics, specifically Mark Carney. Sounded a bit downbeat.
Yeah, you could say that. He views Carney as very competent, but potentially pursuing policies, energy policies, fiscal policies that Rule sees as harmful to the resource sector. More formidable, perhaps, than previous leadership in pushing that agenda.
So increased concerns about the Canadian resource environment.
Definitely. Worries about higher taxes or royalties, tougher permitting. He suggested investors might need to factor in a higher political risk premium for Canada now.
Shifting to management, executive compensation is something Rule feels strongly about. What's his main principle?
Alignment. He really wants to see CEOs and top execs owning a lot of company stock. His benchmark is at least 5 times their annual salary. Skin in the game.
And he's skeptical of bonuses.
Especially bonuses tied to vague goals. He much prefers equity-based pay linked to long-term share performance. And he warned you, the investor, to look at the total compensation package, not just the base salary. Understand the options, the grants, everything.
Makes sense. We've covered Rick Rule's thoughts on AI disrupting analysis, the importance of cycles, especially in this gold market, and the critical factors diligence, patience, psychology for resource investing.
And don't forget that free stock ranking offer really valuable direct feedback potential there. Definitely check out the Rule Investment Media site, the boot camp info, the symposium details if you want to learn more.
Absolutely. And just one final thought for you to chew on as we finish. We've talked a lot about principles like value, cycles, intellectual honesty within resources. How might those same core ideas apply as you navigate other parts of the market, other sectors, in this really fast-changing world we're in, technologically and economically? Something to think about.